Hi, this is Stuart Wemyss and welcome to the Investopoly podcast. My goal is to share easy to understand evidence-based holistic insights to help you master the game of building wealth. And in my regular Wednesday episodes, I talk about the theories, methodologies and principles associated with investing, but the aim of these case study episodes is to share how the application of that approach works out in real life situations by sharing, a story about a client that we've been working with. So the client I would like to talk about today, we started working with them in early 2015. At that time, they were 54 and 51. So I guess early to mid 50s, if you want to describe it in that way. The male was earning about $200,000 a year and the female over the last 10 years has earned somewhere between 100 and 200,000. So pretty strong family income, although there's been a couple of breaks with the female's employment. That was just circumstantial. When we started working with them, they had about $500,000 of net investment assets. And their goal was obviously 10 years sort of retirement plan. So 10 years down the track, they wanted to retire. Obviously, $500,000 of assets wasn't going to be enough. They immigrated to Australia from South Africa, so they didn't have a lot of super because they hadn't been contributing, obviously, until they arrived in Australia, and they were a little bit sort of late starters. They did hold some investment properties, unfortunately not great assets. They co-owned a couple of investment properties with some friends, so sort of owned 50% of two investment properties, and they had one investment property they owned themselves, but they weren't great assets. And they were in Perth. And if you cast your mind back further than 2 years ago, you know that Perth was really stagnant, in fact, in decline for, probably about 13 years prior to 2023. It was in terrible market conditions. So those three investment properties and their share of the two and the one they owned 100% of, total value was about $1.2 million and they had $760,000 of debt. So about $440,000 of equity. And that's pretty much, most of their assets. They had some super, 100 plus 80, so about 180 in combined super at the time. So that's really where their investment assets were sitting, some in super and some in this property that, wasn't great property. So fast forward 10 years, their net investment assets have now grown to over $3 million, about $3.2 million. So about a six-fold increase over the last 10 years. The home is worth, and I don't include the home value obviously in net investment assets, but the home's worth now about 1.6. So there's been a $700,000 increase in equity over the last sort of 10 years, which is probably mostly come in the last 2 or 3 years. The investment properties still co-own two and own 100% of one. Haven't really changed much in value despite Perth's market taking off. I'm going to come back to those assets in terms of talking about those assets in our approach. So worth maybe 1213, so very little change in value, but the client has repaid some debt. So the net debt is down to $340,000. So the equity in those investments has increased from 440 to 760 over the last 10 years solely because of the debt reduction. In 2018, we bought a investment grade apartment in Melbourne for $740,000. That asset hasn't changed in value, unfortunately, over the last 7 years. Well documented, particularly in this podcast, that we've seen actually real decline in values, net of inflation in Melbourne over the last 7 years. Thankfully, in 2025 so far, we're seeing that turn around and we're actually seeing some good, strong growth in the investment grade apartment market as well. Still early days, so I wouldn't be hanging my hat on a complete turnaround, but the signs are looking good. And again, as I've spoken about in this podcast many times, we expected that turnaround at some point over the next few years. But the client's been really focused on debt reduction again, and only has about $140,000 of net debt against that asset, so $600,000 of equity. We've been making some regular investments. Starting in 2020, we started making some regular share investments. So they have a share portfolio, which is really ETF and managed funds, all rules-based, low-cost indexing, as I talk about on the podcast. But it's about $600,000 in a family trust. And combined super is now $1.2 million. Obviously been making maximum concessional contributions over the last 10 years and enjoyed some strong returns. So the super balances are 570 plus 650. So they're getting up there now, even though super's still pretty low for their age, again, because they immigrated to Australia. So the clients are now 64 and 61 and plan to retire in the next 1 to 2, 3 years, sort of draw a circle around that. And they're in a good position to do that. So now what I like to do in these case study episodes is just talk about, what our approach is. And then I like to sit back and reflect, what can we learn? And more importantly, what can listeners learn from this case study? So the first thing is that we really talk deeply about the co-owned assets in Perth. And of course, when we started working with them in 2015, that market was in the doldrums. And the properties weren't costing them too much in terms of cash flow. They were costing them in terms of borrowing capacity. They were eating up some of their borrowing capacity, but we felt like that's okay. We still have enough borrowing capacity to invest elsewhere if we wanted to. So our view was, let's hold on to these assets. Let's try and divest of them strategically when the timing is right. The challenge has been co-owning those two investment properties. And this is a bit of something that we can learn from this case study is co-ownership. It might sound fantastic at the beginning. When you're talking with friends or family, let's go and put some money into a property together. But it really tends not to work out very well in the long term. People's views, situations, outlook, desire what to do with equity, all those things can change and typically do change over time. And you tend to get a situation where, one owner wants to do something like my client, let's sell these assets. The other owner, no, we don't want to do that. Or they're procrastinators, that talk about doing it but never get round to actually doing it. So we have wanted to, and particularly over the last couple of years, we've wanted to exit these investments, particularly as they're not growing with the market, the overall market in Perth, but we haven't been able to do so. It's getting so close to retirement now that because of depreciation and so forth, we're going to have a capital gains tax event. We may as well hang on to them for another couple of years and sell them when the clients don't have any other personal income in their personal names to minimise capital gains tax. But what we did instead is mitigate the risk of underperformance. Unfortunately, the Melbourne market hasn't complied for all the reasons, COVID and the mismanagement of the government and additional land taxes and all those sorts of things. All those things obviously difficult to forecast and it hasn't worked our way. But the idea was, let's buy an investment grade apartment in Melbourne. At least we're in the market and we're going to hopefully get some growth even if the Perth properties don't work. Add some gearing in there, a bit of a full savings mechanism as well. And in the long run, we'll be better off. Now, in the long run, we will be better off. What was difficult to understand or predict was, growth in the Melbourne market. I feel like we're coming towards a growth cycle now, so it'll work well for the clients, particularly that they've been able to repay debt. We'll exit those Perth property investments. That'll realise some cash, will boost up super. And then we'll keep the Melbourne investment property, which will be cash flow positive. And they'll enjoy the next 10 years of growth, which again will underpin super. So, we'll use super assets and what's in the share portfolio. We'll move some of those assets out of the family trust also into super. So we've got a pool of good liquid assets there to fund the kind of first phase of retirement, if you like. I estimate there's about $1.5 million almost. No, actually, there's going to be more. There's over $2 million of those liquid assets in the family trust, in the Perth properties and in super. That'll fund the first phase. And then if we, in 10 or 15 years' time, we start to get a low balance, we can sell the Melbourne property and hopefully have benefited from good compounding capital growth over that time. We knew we wanted to invest more though. So, about 5 or 6 years ago, we talked about, okay, there's only so much we can contribute to super, but we need more growth assets. And then that's when we started accumulating a share portfolio in a family trust. Now, in the family trust, that's going to give us some flexibility because it's quite possible that the female will stop work before the male, and that way we can gradually move some of those assets and minimise capital gains in doing so into super. And it gives us that flexibility going into retirement also. So I guess it's another way of getting money into the market and then gradually changing the ownership of that money, from outside super to inside super over the next 5 or 6 years. And the goal then is also to sell the Perth properties, as I've already mentioned, and get that into super. So over the next 5 to 7 years, I think we'll have much healthier super balances than what we have today. And that's kind of always been in the strategy. The other thing I've tried to do with these clients is encourage them to reduce the amount they're spending on insurances, life insurance, TPD, income protection insurance. Their premiums have really increased. And it's really funny, well, not funny, it's interesting in terms of human behavior. When clients have insurance policies for a long time, I find it difficult to get them to agree to reduce cover over time. They feel like, I think we all get sort of just used to, telling ourselves, I've got this insurance and I feel protected and that's why I'm paying the premium. Whereas people with no insurance, it's difficult, and I think they really need at least some. It's really difficult to educate them. But, the whole thing around insurance, I think, listeners need to understand is that it is necessary when your asset base is weak. And when your asset base is strong, particularly as you get closer to retirement, you have enough assets, to fund retirement, it's not dependent on working anymore. That's when you need to really, I would say, aggressively reduce insurance cover in order to save costs. Now, that's the theory. In practice, it's difficult to implement with clients from my perspective. And of course, over the last 10 years, we've optimized super. So it's been really important to obviously maximize contributions, but making sure that super is performing, getting the right returns and so forth. And on average, we've achieved returns of 7 to 10% over the last 10 years. So we've made sure that portfolios are well invested. We couldn't take too much risk because, it's not like they had a huge runway and or a huge balance, but we wanted to make sure we captured those returns. And so I think, when you look at our risk-adjusted returns, they're pretty good. We haven't taken much risk and we've enjoyed some decent returns. So what can listeners learn from this case study, and what can I learn as I look back at working with these clients? So, the first thing is they've made a significant contribution to their increase in investment assets. As I said, they've gone from about $500,000 to over $3 million of investment assets. And by rough calculations, about $1 million of that, so 1/3, has been a result of debt reduction. So they're really good at managing cash flow, carving off savings and gradually reducing debt. And, debt reduction's a funny thing. It's not always my preferred strategy. It can be a bit conservative. In their situation, it was fine. But it's easy to underestimate the power of debt reduction because, we might sit back and go, okay, we've repaid $30,000 this year. And then next year you repay another $30,000. You go, okay, it's $60,000 over 2 years. You think this is hard work. I'm not really getting ahead. But if you do it consistently for a long period of time, it starts to really compound, I guess, those savings and the impact on your asset base. So cash flow management really is key. Of course, we didn't want to just focus on debt reduction. That's why we did the regular share investing, putting money into the family trust. That's why we maximised super contributions. And if I had my time again, of course, we're all smarter in hindsight, I probably would have bought a house in Melbourne in 2018 rather than an apartment. I'm not sure we'd be miles in front. In fact, maybe it would have been better to buy a house in Brisbane. Well, definitely would have been better to buy a house in Brisbane in 2018. We bought in Melbourne an apartment just because of the price point. We only spent $740,000. And because the clients were nearing, the male is 64 now. So it was pretty close to 60 at the time. We wanted to give ourselves enough flexibility in case circumstances changed. So we didn't want to push the envelope to, investing $1 million or $1.5 million probably at that time because we thought it was taking on too much debt. It was too aggressive for the age and stage of life. But actually, in hindsight, seeing the capacity to reduce debt since that purchase in 2018, and because of relative performance of markets, which, isn't always obvious, it's probably more obvious to me in the work that I do today than what I did back then. But it was mainly the purchase price limit that was the driving factor. Anyway, looking back, I probably would have bought the house in Brisbane. Of course, we're always smarter in hindsight, but it'll work. The whole strategy was really to have a property asset that's going to give us compounding capital growth to underpin super. In case the returns when they get into retirement are going to be less than average or below average, and or they eat into their super at a faster rate than what we expect. And the Melbourne apartment will definitely do that. It is a sensational asset. It's a great asset at a great price. And that, as I said, that market's starting to move again. So cash flow management, I think, is one key element. Taking advice, I think, is another key element. I mean, in their situation, because they moved to Australia, they didn't really have, necessarily a lot of ideas on how to manage their own money. So they really needed to, and they had a 10-year window of like, okay, we've got some good cash flow. Their kids were adults at the time, or very close to adults at the time when we started working together. So, their expenses kind of reduced and they had greater level of surplus cash flow, and they knew they needed to make some smart decisions over the next decade to put themselves in a really good position to retire, which they've done. So, they picked the point in time, I think, perfectly around, working with an advisor, getting some advice and building a long-term strategy and sticking to that plan. So that, I think that's worked out really well for them. And the other key learning is the insurance. I wish we could have reduced insurance further. Now, it's difficult. It's not really my place to say, because my goal is to educate clients to make an educated decision. I believe I've done that. They've decided to keep a level of insurance that they're comfortable with. So it's not for me to judge that, because we all have different risk profiles. But I think talking to the wider listener base of this podcast, it's something to keep in the back of your mind. My view is that, when you're in your, say, 30s, you've got a young family, a relatively low asset base, relatively high leverage, relatively tight cash flow, that's the situation where, to my mind, you're at peak insurance needs. I think in that situation, you should go out and get as much cover to put yourself in as a stronger financial position should something go wrong as possible. And in your 30s, it's cheap. You can get a couple of $1 million of life cover, for example. It's only going to cost you a couple of grand or something like that. Like, relative to the benefit, it's cheap cover. And then, of course, you spend your 30s and 40s, you're really working hard, investing, making some really good decisions, etc. When you start to get into your 50s, you should be in a position where you now can take on a little bit more risk. You've got a better asset base. You don't need as much insurance cover. And then that's when I would aggressively reduce. So I'd aggressively acquire insurance in my 30s, aggressively reduce insurance in my 50s. And that's the way it should really work, to my mind, to achieve the most efficient outcome. And of course, it aligns perfectly with the cost-benefit analysis as well. Like, if you can get insurance in your 30s and it's cheap, that's great, get it. But if that insurance starts to become quite expensive in your 50s, of course, the cost-benefit analysis changes, and therefore your level of cover should change. So, I mean, looking back, the timing of the markets and so forth, I'm not going to say we should have bought in Brisbane because it would have been a different price point, but that's something we can sort of look back on, and, whether we were being sort of too conservative with the amount of debt that we're taking on. Having said that, the strategy is still going to work. It would just be a little bit nicer if we saw some growth over the last 7 years since owning that property. But building more growth assets outside super, like if you're already maxing out super, try and build those growth assets outside of super with the view to then moving them into the super system, post-retirement when it's tax effective to do that. And then I think the other big learning here is co-investing. Be really careful with it. I've seen siblings do it, and sometimes that's probably the most successful. I'm not saying it's going to be successful, but it is the most successful scenario, where two siblings that are relatively similar in age go and buy their first property together, for instance. That can work well at times. It's not a long-term situation, so you put a limit on it. Let's do it for 5 years and then review it. And that's pretty much the best way to go. But for anyone else that's thinking about co-investing with friends or family or something like that, I just caution you with respect to that. It tends to not really work out in the longer term. Okay, let's get into some listener questions. And the first question is from Vanessa. Vanessa provides some lovely feedback about the podcast and how valuable it is, so I appreciate that. Always appreciate any positive feedback, of course. And Vanessa's asking has a question about $1 million she will receive as an inheritance via a testamentary trust and wondering what to do with that money. Vanessa's 55, her husband is 61, want to retire about 65, spend about $80,000 a year, so that's what they want in retirement. Have 3 children, one is married with a baby, 25-year-old works full-time and the 18-year-old is still at home. In terms of their financial position, combined income about $160,000, mostly earned by the husband, who has 4 years left of his planned working life. About $500,000 in super, some investment properties with 2 investment properties, I should say, one in Brisbane, one in Sydney, with about $700,000 of equity in them. Tiny bit of business debt, less than $60,000. The home's worth $2.3 and about $50,000 in cash. And Vanessa lists out a few different options in terms of what she could potentially do in terms of putting the money into super, buying investment property, investing in shares, and those sorts of things. Well, before I get into my answer, let's just talk about testamentary trusts. If you receive monies from an inheritance, if a minor receives money, so someone under age 18 receives money from inheritances, that income and capital gains from that pool of assets is taxed at adult rates. So one of the best ways then to quarantine those monies and give you the most tax flexibility is to put it in a testamentary trust, which means that $1 million can go into a testamentary trust. Vanessa mentioned one of her children, the oldest, the 26-year-old, is married and recently had a baby. So we could distribute $20,000 to that baby and they're not going to pay any tax. So from a taxation planning perspective, it's a really good entity and a good structure to have. Now, the thing you want to think about then once you do have a testamentary trust is that even if you don't benefit from the structure today, that is that, say you had children and you didn't have any grandchildren, so no minors to distribute to, you might say, I don't need the testamentary trust. But if down the future you might have grandchildren and therefore it then can become quite tax effective. So what I would do in their situation is you want to think about then, I've got this testamentary trust, we've got $1 million of capital in this testamentary trust, how can we preserve that? The other thing is that a few years ago, probably about 5 years ago now, the government sort of tightened up the rules around testamentary trusts. You used to be able to make additional capital contributions into that trust and still get the same tax benefits. You can't do that anymore. So the $1 million is in the testamentary trust in Vanessa's situation. That's the maximum she's ever going to have in that tax-effective entity. I looked at their situation, I think they've got some gearing. Their total loans against the investment properties are about $670,000 on their income of about $160,000. So, I would say that, and there's about a 50% LVR, I'm just looking at some rough numbers. So should they go and buy another investment property if they want to retire in 4 years' time? No, I don't think so, because I think that it's going to give rise to too much debt, too much gearing at the wrong stage of life. And they already have some gearing in property, so why do we need more? So I wouldn't invest in property. They've got $535,000 in super, so they're quite light on in terms of super balance. So I would probably really focus on that. And then the other thing I would think about is that I could have some assets outside of super just to give me a little bit more flexibility and benefit from the tax benefits of the testamentary trust. That is, I can earn, $20,000 and not pay any tax. And then, of course, even if I earn up to $45,000, I'm only going to pay about $5,000 of tax on 45. That's about 11%, still pretty tax effective, right? So, of course, the information in this podcast, or what I'm giving you now or talking about, is only information. It's not advice. It's never advice, of course. But what I'd be thinking about doing is something along these lines. The testamentary trust would lend Vanessa $600,000. And so you'd have a loan agreement between the trust. It can be a zero interest rate agreement, but essentially you're borrowing $600,000 from the trust. And I would use that to make non-concessional contributions into super. You try and even up the super balances, so you can make 3 years of bring forward contributions, so that's $360,000 per person. Or in fact, you could make a $120,000 contribution in June this year and then make another $360,000 in July, because you're going into a new financial year and you're almost getting, $480,000, I think, into super. So you could potentially take $600,000 out of the testamentary trust and you could potentially put most of that in one person's account to try and even them up. But that's what I would do. That would boost your super to over $1 million then, and at least then over the next 4 years until your husband's 65, as long as you're in a good fund, low fees, good returns, that should really benefit from some compounding earnings before he gets into retirement. Then I would leave the $400,000 in the testamentary trust, and I would, invest that in maybe some diversified ETFs. So maybe balanced or growth, depending on your risk profile, Vanguard or Beta shares. Well, Beta shares mostly all growth, but Vanguard has, more balanced options, that includes some bonds. And the reason I say 400,000, what I was really thinking about is, like, even if that generates, let's say, $30,000 of taxable income, we can distribute that to your 26-year-old's child. And even if you pay some tax, it's not going to be much. You'll probably get some franking credits. It'll probably net it all out. You're probably not going to pay very much tax on it at all. But at least you've got the flexibility of having that pool of assets, that 400,000 in a testamentary trust, in case you want to access it between now and retirement or do anything else with those monies. The other thing you could do is borrow the 400,000 from the testamentary trust and pay interest on those monies. So you could put it in your offset account, and then the testamentary trust could charge you the same interest, what you're being charged. And then that income can then be distributed to the minor. That could work depending on, what you might, sort of risk profile and so forth. Although your gearing level's not too bad, so I probably wouldn't do that. I'd probably go more growth assets and invest it in a diversified ETF. But that's the sort of theme that I'd be thinking about in terms of planning around these monies. And the key element, the critical planning element here, is borrowing from the testamentary trust. So having a loan agreement, so you can always put that money back in the testamentary trust. So here's what I'm thinking longer term. That if, for instance, down the track, towards the end of your life, and you expect your longevity is very, very short, your lifespan, I should say, is very, very short. At that time, what you could do is take all your money out of super, because that's not going to attract any tax, and then repay the testamentary trust loan. So put it all in the testamentary trust. And then in terms of creating intergenerational wealth and passing that wealth on in a really tax effective manner that's not going to attract any tax on the estate, that would be a really great way to do it. So that's why I'm saying structuring it as a loan rather than a capital distribution from the testamentary trust is good, because you've got that planning opportunity down the track. And really, just as a general rule, that should be the strategy, is that, of course, when we have a binding death benefit nomination inside super, most people, if they're married or have a spouse, they nominate their spouse. That's fine. When one spouse passes, the surviving spouse should then be really careful about, of course, we never know how long we have left on this planet, of course. But if we do know, if we start to get to a point in time where we think, well, our life expectancy is pretty short, take all the money out of super, because that way it's not going to attract any tax to a payment to a non-beneficiary non-financial dependent or non-interdependent relationship. And that's a good planning strategy for anyone that's, worried about that. Okay, so Vanessa, hopefully that's a really long-winded answer, but I wanted to sort of delve into testamentary trusts and how you could use them from a planning perspective, but I hope that's helpful. Okay, the next question I have is from Pierre, but I might leave that one for tomorrow because it's a pretty long one and I don't want to overextend my welcome. So I'll leave it there, and tomorrow I'm going to talk about structuring investment properties. So how to do that in personal names, what are the different options, and just share some tips on optimizing taxation and cash flow outcomes and all that sort of stuff. Okay, thanks a lot. Just a few things before we wrap up, if I may. Of course, you can send me questions at questions@investopoly.com.au. But for a quicker response, feel free to add a comment on the episode's video over on YouTube. We have an Investopoly YouTube channel and the link is in the show notes. I'm incredibly grateful for the 4.9 star rating on Apple with over 400 reviews. Thank you so much. If you can leave a review or rating, I'd love it because I'd love to get over 1,000 reviews. That's kind of my target. Keep checking the show notes for free downloads, and I include book discounts there as well. And of course, if you're interested in working with my team and I've included a web link where you can find out a little bit more about what we do and get in touch with us. And of course, until next time, bye for now.